There's a recurring omen in economic history, a quiet pulse that begins long before collapse. It starts with confidence, grows into complacency, and ends with a single fatal belief that a nation can print prosperity faster than it can create it. Rome felt this pulse in the 3rd century. Its borders expanded faster than its tax system. Its armies consumed more than its miners could dig, and emperors diluted the denarius until the silver inside was barely a memory. Markets didn't crash overnight. Trust simply thinned like a thread pulled too far, and then it snapped. The Weimar Republic heard the same warning in 1923. Factories stood still, debts towered, and leaders insisted that printed money could substitute for real value. Prices doubled, then doubled again, until life itself became a race against the clock. People rolled wheelbarrows of notes to buy stale bread, and the world watched a society dissolve into paper and fire. Japan sensed the whisper in 1990. Its miracle economy softened into stagnation. To resist gravity, policymakers turned to the quiet magic of quantitative easing, decades of liquidity, zero rates, and trillions created with a keystroke. Japan survived, but it never woke from the long, slow sleep that followed. And now the United States, the architect of the global financial system, stands on the same threshold. Picture the scene: a treasury overshadowed by record deficits, a central bank cornered by political demands, and a population drowning in the rising cost of ordinary life. Each crisis demands more liquidity. Each downturn requires a bigger rescue. Each solution creates a larger dependency. The dollar still dominates. Markets still trust it. But beneath the surface, the same cracks that once appeared in Rome, Weimar, and Japan spread quietly through America's foundations: debt that grows faster than GDP, spending that outruns revenue, and a political system that can no longer say no. Money is still being printed. The machine is still running. But the pattern had already begun, and now it's happening again. At the heart of America's economic engine lies a truth so uncomfortable that politicians avoid saying it, central bankers carefully rephrase it, and citizens feel it before they understand it. The United States no longer grows fast enough to support the promises it has made unless it creates money to fill the gap. This is not merely a policy choice. It is the structural consequence of a system built on long-term borrowing, short-term expectations, and a global financial order that relies on the dollar as both anchor and illusion. For decades, America balanced its ambitions on a formula that seemed too elegant to fail: borrow cheaply, spend freely, innovate constantly, and let the world absorb the difference. That formula held until the weight of its contradictions began to surface. The story begins with debt, government debt rising faster than GDP. Corporate debt swelling to buy back shares rather than build new capacity. Household debt growing as wages stagnate and the cost of basic life, housing, healthcare, education climbs beyond reach. Every sector consumes more credit than it can repay through organic growth. Every weakness is patched not with reform, but with liquidity. Money becomes the universal solvent. Why does America keep printing? Because the alternative is unthinkable. Raising taxes risks political suicide. Cutting spending risks social unrest. Letting markets correct risks systemic collapse. So leaders choose the only path left to engineer stability by expanding the money supply, hoping each injection buys enough time for growth to catch up, even though it rarely does. The Federal Reserve becomes the silent partner in this arrangement. It cannot allow recessions to burn freely because the modern financial system is too interconnected, too leveraged, too fragile. So it steps in with quantitative easing rate cuts, emergency lending facilities, liquidity injections, and the quiet promise that no crisis will be allowed to run its natural course. Markets rise because they expect intervention. Governments spend because they expect low rates. Citizens borrow because they expect inflation to remain controlled. Every decision assumes the machine will keep running. But the machine's logic has changed. Each round of intervention must be larger than the last. Each slowdown requires more stimulus to restart the economy. Each crisis creates a precedent that becomes the new baseline. A society accustomed to artificial stability becomes dependent on it. Underneath the economics lies psychology, the belief that the dollar is immortal. For generations, Americans have lived inside a system where their currency dominates global trade, where the world buys U.S. debt without hesitation, where the financial empire looks eternal. But confidence is the most fragile currency of all. Once lost, it cannot be printed back into existence. The deeper structural forces make printing inevitable. An aging population increases entitlement spending. Slower productivity growth weakens real wealth creation. Geopolitical competition demands higher defense budgets. Polarized politics removes any hope of fiscal discipline. And global instability forces the U.S. to act as the lender and printer of last resort. Money creation is no longer an emergency tool. It is the bloodstream of the system. History shows that nations rarely print out of greed. They print out of necessity. Rome printed to defend its borders. Weimar printed to survive its reparations. Japan printed to escape stagnation. And the United States prints to prevent the collapse of a debt-fueled, expectation-driven economic architecture that no longer functions without constant injections. The tragedy is not that America prints money. The tragedy is that it has built a system in which it must. History proves it again and again. Every great financial decline begins long before the first crisis appears on the surface. It begins in the quiet spaces in balance sheets and budgets and promises made decades earlier. The United States was no exception. What looks today like a cycle of endless money creation began as something far more ordinary, the slow construction of a machine built on debt confidence and momentum. Stage 1. Expansion masked as destiny. In the decades after World War II, America built an economic engine the world had never seen. High wages, cheap credit-growing industry, and unmatched geopolitical power created a sense of inevitability. Debt existed, but it was small, proportional, manageable. The system breathed easily. Stage 2. The first imbalance. By the 1980s, the machine shifted. Tax cuts, Cold War spending, and the birth of the consumer credit economy launched the U.S. into its first structural deficit era. Politicians discovered a powerful truth debt could sustain prosperity without raising taxes. The public embraced it, markets rewarded it, and the national habit began. Stage 3, households follow the empire. As the government borrowed, so did the people. Mortgages expanded, credit cards boomed, universities raised tuition, and corporations shifted to debt-financed growth. Debt became not a burden, but a tool, a cultural norm. America began to treat tomorrow's income as today's fuel. Picture this, a society gliding forward on invisible rails, unaware that each rail is held up by leverage and each year the height of the rails grows. Stage 4, the trap closes. In 2008, the machine cracked. Lehman Brothers fell, banks froze, markets trembled. For the first time since 1929, the U.S. faced systemic collapse. But instead of allowing the system to reset, the Federal Reserve intervened aggressively, slashing rates to near zero and launching quantitative easing. Liquidity replaced discipline. Stability replaced correction. And this created the turning point of the century. America learned that printing money could save the system. Stage 5. Dependency becomes design. From 2010 to 2020, markets grew addicted to stimulus. Corporations borrowed at near zero rates. Asset prices boomed. Government deficits became normalized. Every downturn, every shock, every political promise began to rely on one assumption: the machine will be fed. Then came 2020. Congress deployed trillions. The Fed expanded its balance sheet by historic levels. For the first time in U.S. history, newly created money directly entered households and businesses. The machine was no longer hidden, it was national policy. By the time America realized it could not stop printing without collapsing growth, the pattern was already locked in. The machine was complete. Once a nation becomes dependent on money creation, a deeper pattern unfolds, one that is not visible day to day but unmistakable across decades. It begins with currency dilution, though never announced, never admitted. The dollar remains, the reserve currency markets remain strong, but purchasing power erodes silently. From 2000 to 2025, wages rose 80%, but housing rose 200%. Healthcare doubled, education tripled. Essentials inflate faster than income, the signature of an economy absorbing newly created money. Stage 1, wealth concentration accelerates. Freshly created money enters through financial channels, banks, asset managers, corporations. Those closest to liquidity accumulate capital. Those furthest lose ground. Rome saw its elites consolidate land. Weimar saw industrial magnates profit while workers starved. In America, the top 10% now control 70% of all wealth. Stage 2. The middle class erodes. As inflation outpaces wages, the dream of upward mobility weakens. A nation built on the promise of abundance begins to feel scarcity. Millennials delay buying homes. Gen Z doubts retirement. A society that once saw the future as brighter now sees it as narrower. Economists call it inflation. Civilians call it life getting harder. Stage 3. Political fragmentation. The pressure of unequal inflation fuels polarization. Each group demands solutions that contradict the others: higher spending, lower taxes, more stimulus, less intervention. Rome fractured under rival generals. Weimar shattered under street factions. In the U.S., distrust grows not because people changed, but because the system around them did. Stage 4. Institutional strain. The Federal Reserve faces an impossible equation. If it raises rates, the debt machine cracks. If it lowers rates, inflation returns. Each choice carries consequences. Trust weakens. Markets grow hypersensitive. Policy becomes reactive, not strategic. Picture this: a central bank navigating a storm with a compass that spins in every direction. Stage 5. The world adapts. Rival economies restructure their systems around American vulnerabilities. China expands industrial dominance. BRICS explore alternatives to dollar settlements. Energy trade experiments with bypassing U.S. currency. These shifts occur slowly, then suddenly. Reserve currency status erodes not through collapse, but substitution. Stage 6. Dependence becomes destiny. By now, money printing is normalized. The nation cannot reverse the cycle. It can only extend it. By the time they realized, it was too late. History's final phase doesn't begin with chaos. It begins with comfort. Stage 1. Artificial prosperity. Markets soar not because productivity surges, but because liquidity sustains them. The stock market becomes a reflection of monetary policy. Real growth weakens. Corporate profits rely on leverage, not labor. The foundations grow thin. Stage 2. Asset. Essential divergence. Homes, stocks, crypto luxury goods inflate rapidly. Essentials: food rent, healthcare strain households. This widening divergence is a universal symptom. Rome's grain prices, Weimar's bread lines, Japan's asset bubble. When money loses its anchor, prices detach from reality. Stage 3. The feedback loop. Government deficits expand. To fund them, new bonds are issued. To support bond markets, the Fed intervenes. To prevent recession rates decline. Lower rates fuel more borrowing. More borrowing fuels more printing. It becomes a closed system, a snake eating its own tail. Stage 4. Global trust fractures. A reserve currency depends on global confidence. Once major economies hedge, that confidence erodes. Not visibly, not dramatically, but quietly, through bilateral trade, alternative clearing systems, and diversification away from U.S. debt. A tide turning under calm water. Stage 5. Political upheaval. Internal tensions reach their peak. Inflation divides generations. Debt divides parties. Economic reality divides institutions. Historically, this stage always precedes the final transformation. Stage 6. The reckoning. An empire does not collapse, it adjusts violently. Spending must realign. Promises must contract. The currency must find equilibrium. The global order must shift. The process is painful but not unprecedented. Picture this: a twilight empire surrounded by the glow of its former glory, held together by a machine humming beneath its streets, a machine that cannot stop, because stopping means confronting everything avoided for decades. History doesn't repeat, it evolves, and the next stage has started. The pattern that once reshaped ancient empires is no longer confined to textbooks. It is visible now in the price of a home, the cost of a meal, the tone of political debates, the instability of financial markets. What America faces in 2025 is not a crisis of numbers, but a crisis of structure, the quiet realization that the system requires perpetual support to remain standing. The national debt exceeds $34 trillion, rising faster than GDP. Interest payments surpass both defense and Medicaid. Every projection shows deficits growing indefinitely. Economists describe it clinically, but beneath the data lies something older. A civilization running faster simply to remain where it is. Inflation has not disappeared. It has transformed. The official rate may decline, but prices do not return to earth. They plateau at a higher altitude. Families pay 30-50% more for basic goods than they did 10 years ago. The wage increases that follow are not growth, they are compensation for decay. Historical patterns show the same dynamic. Rome's grain prices never returned to pre-debasement levels. Weimar's costs remained distorted even after stabilization. Japan's real wages stagnated for 3 decades. Asset prices, meanwhile, float in a different world. Stocks soar on liquidity despite slowing productivity. Real estate appreciates even when demand weakens. Investors celebrate artificial calm, unaware it is the calm of a sealed room with limited oxygen. Wealth flows upward because newly created money enters the system from the top. Those with assets thrive. Those without struggle. The distribution is not accidental. It is the inevitable geometry of monetary expansion. And behind every headline, one fact remains immutable: the U.S. financial system cannot tolerate a prolonged period of high interest rates. If rates stay elevated, government interest costs explode, corporate defaults rise, and markets recoil. If rates fall, inflation resurfaces, debt accelerates, and trust weakens. Picture this: a corridor narrowing with every step, dimly lit, with doors closing behind rather than opening ahead. That is the architecture of 2025. And now we are walking the same road they once did. History's logic has not changed, only its instruments have. What once took decades to unfold now happens in cycles compressed by global markets, instantaneous information, and political systems that cannot slow down without breaking. In 2025, the parallels to past empires are sharper than at any time in modern American history. First, consider the geopolitical realignment. China's manufacturing power continues expanding, creating a gravitational field that pulls global trade eastward. BRICS nations test settlement systems outside the dollar. Middle Eastern energy deals shift toward diversified currencies. Even U.S. allies quietly build financial redundancies. This is precisely how reserve currencies decline, not through dramatic collapse, but through 1,000 subtle alternatives. Second look at political fragmentation. In 2025, the U.S. enters another election cycle with unprecedented polarization. Each side demands incompatible policies, more spending or strict austerity, lower taxes or expanded welfare, aggressive monetary tightening or new rounds of stimulus. Politics becomes a reflection of economic stress. When the middle class weakens, consensus dissolves. When consensus dissolves, governance stalls. And when governance stalls, printing money becomes a substitute for difficult choices. Rome lived this, Weimar lived this. So did Britain after World War II. Third society itself bears the pressure. Young Americans carry record student debt. Families confront housing markets that drift out of reach. Retirees depend on programs strained by demographics. A nation once defined by upward mobility now feels the gravity of stagnation. Inflation becomes a psychological force, shaping expectations, altering behavior, eroding trust. And trust once lost cannot be printed. Fourth, financial dependence intensifies. Markets no longer rise because companies innovate. They rise because investors expect intervention. Every downturn triggers speculation about rate cuts, not resilience. Every shock raises the question of stimulus, not strength. The cycle becomes a loop. The system weakens. Interventions increase. Interventions weaken the system. Picture this, a modern empire illuminated by screens, data, and wealth, yet powered by the same ancient mechanism that once weakened older civilizations, the belief that money creation can outrun structural reality. History doesn't repeat, it evolves, and the next stage has already begun. Every empire reaches a moment when it can no longer outrun its own momentum. A moment when the stories it once told of endless growth, limitless prosperity, unshakable strength, no longer match the reality beneath its surface. Rome faced that moment when its coins turned from silver to shadow. Weimar confronted it when paper became dust at dawn. Japan accepted it in the long winter of stagnation, standing still as the world moved around it. And now the United States approaches that same quiet threshold. It does not arrive with fire or rebellion. It arrives with recognition. Recognition that the system no longer expands without intervention. Recognition that the debt machine cannot slow without unraveling what is built upon it. Recognition that money creation is no longer a remedy, but a requirement, the lifeblood of a structure too interconnected to endure a pause. Picture this, an empire at dusk. Skyscrapers shimmer as if nothing could touch them. Markets float with an unnatural calm. The dollar still commands loyalty across oceans. But deep below the brilliance, the foundation strains. Years of promises, obligations, entitlements, debts, and expectations press downward like sediment on ancient stone layers of decisions made to avoid the pain of adjustment. History's final lesson is rarely destruction. It is transformation. An empire confronted with its limits must choose shrink or stretch, adapt or fracture, accept reality or attempt to defy it through illusion. Some nations recalibrate, shedding old burdens like a serpent shedding its skin. Others harden against change, clinging to the symbols of power, even as their substance fades. The United States is not predetermined to fall, nor guaranteed to endure. It stands instead in the narrow space where all empires ultimately arrive, the space where denial becomes impossible, and choice becomes destiny. To confront the cycle means acknowledging the weight of decades. To extend the cycle means binding the future to decisions made long ago. One path promises stability through humility. The other promises momentum through illusion, but only for a time. Empires do not collapse because they are struck from outside. They collapse when the internal stories that sustained them grow too heavy to carry stories of endless growth, limitless credit, and prosperity without cost. History doesn't repeat, it evolves, but its warnings echo with uncanny precision. And now, as the machine hums beneath the American night, we are living inside the prophecy.